Lo, you're seeing the carnage just as we are. And really, you can't help but note that as bad as it is for the NASDAQ, it's really the mega caps, even though they are falling, they're masking what is going on underneath. And you're just seeing brutal selling across semi, software, fintech, losses of 5 to 10% is what I'm seeing on my charts.
Yeah, look, I mean, this is something that I think we're seeing exacerbated a little bit just by the anticipation. We're seeing that we've left 21 where we had the major indices at all-time highs or near all-time highs, and large tech continued to outperform. But look, we've got some big headwinds that are heading our way. And we know that there are macro concerns with inflationary fears, Fed tightening, and the potential for growth decline. And then couple in some of the things that we're seeing with COVID, this new variant. Look, historically, when rates go higher, valuations compress, particularly on those growth stocks. Now, I do think there are some interesting trends that we'll see that will continue to allow the best of the large tech to continue to outperform, because there is no slowing these companies down. However, I do believe that some of the more speculative tech names that had smaller margins will continue to suffer near term.
Yeah, and a lot of these, high momentum names have been focusing on becoming more than just features, becoming platforms, right? Whether they use their stock price or cash that they had, but the current market environment is making that tougher. So where do they go from here? Is there opportunity, or does the stock price actually hurt their business prospects, what they were planning to do?
Yeah, no, I think, look, the stock price is an indication of where the market believes the company's performance is relative to the potential. And these companies have to continue to execute on their business plans. And we see some major opportunities coming this year. Look, we're going to see continued growth in the 5G technology. We think that's going to benefit Qualcomm in particular in two ways. They have the ability to be able to benefit not only from selling chips, but also in the licensing of 5G technology. That's not just for handsets. That's also for areas like automotive, IoT, infrastructure, et cetera. And, speaking of platform, we believe that Apple is doing an amazing job of creating a platform. Apple is benefiting from the growth in 5G. They've got about a third of the handsets that are being sold. And we also see the potential for Apple to move down market this year with some new handsets that can more effectively compete with the lower end Android units from manufacturers like Samsung. I mean, there's a potential for 1 billion users to come over with these lower priced handsets. And if Apple continues to be able to launch more services, particularly in AR and VR, we think that could be a killer app for 5G.
Lo, good morning. Good to see you. I look at the S&P because, yes, the NASDAQ is hurting. Look at the S&P, and it's hard for me to cry too many tears right now just because, yeah, I mean, it's back where it was in the fall. It had an amazing run in 21, up 27%. For those who had everything they own in growth stocks, thinking that fundamentals don't matter anymore and it's different this time, maybe the Cathie Wood crowd, they might be feeling quite queasy right now. But I mean, for those who hold that the old rules sometimes still apply, was this entirely unexpected? How big of a deal is this drop really?
Yeah, look, I think we're seeing something that is going to be a little more shorter term. To your point, again, going back to what happens when macro moves and particularly macro moves around inflation. This is where we always see the growth stocks hurt. There's a drive towards those stocks that investors on the institutional side in particular feel that there's going to be an opportunity to take advantage of the rate movements and have higher yielding stocks in their portfolios perform better than growth stocks. I think there's a few things. Number one, we do see continued momentum. I don't believe anything is going to slow down the best of the big tech companies because the momentum is just moving in their favor. Even looking at the digital transformation, we believe that companies like Microsoft, Amazon, with their cloud business, with their enterprise sales, they will continue to benefit because these transformations will happen both at the enterprise level for businesses as well as consumers integrating tech more into their lives, whether they realize it or not, realizing it and using an iPhone or not realizing it with all the chips that are powering everything necessary for things like cars and even TVs to refrigerators. So we don't believe there is a slowdown. However, that said, your point about some of these other stocks, again, I go back to taking a look at the margins, the earnings. For the stocks that have thinner earnings, or excuse me, thinner margins leading to, not the big earnings that we see from some of the larger tech companies, I believe that those will suffer. We've got some news to work through this week. We've got some key indicators around inflation. We've got the confirmation of the Fed chairman. We're also going to start earnings season soon. And I believe that we'll continue to see the record earnings that we saw last year. It's going to be a tough comp to lap. 21 was an amazing year, but I believe we'll see continued growth.